Hey, good morning, everybody. Tyler, if you could just get that video clicked on.
Yep, you're working now.
Awesome. Thank you. So good morning, everybody, and welcome to this Wednesday, August 30th, 2023 edition of Trading Places Live. I do want to thank all of you for tuning in. Really appreciate those of you on YouTube and all of our loyal supporters on the EB Digest. Of course, all of our paying members, some of which have been with us for many, many years. Thanks to all of you. Ran into some personal matters over the past few days, so I do want to apologize. Yesterday, I needed to cancel the Trading Places Live session. Today, we were supposed to have an all-day live trading room for our members. That's had to be postponed. I simply haven't had a chance really to look at the market. So I don't think it would be fair to try to host an all-day live trading session without having really reviewed the markets much these past few days. And to top it all off, the emergency I had was down in Tampa. And of course, if you've been following the weather, we had Hurricane Idalia heading right for us down there. So we actually scooted out of Tampa yesterday. I was driving all day. So very difficult to do much with the market. So again, just want to thank you for your patience and understanding, especially our members. We will reschedule that all-day trading session. I don't know that we'll do it. I was thinking about doing it in a week or two later this month, but the problem is everything slows down in terms of earnings. We're kind of in the middle of a not so great market. I think actually trading should be slowed down this time of the year. As I said back in July and repeated in August, I think now is the time to lower your expectation bar in terms of trading. I think that would have been a really good strategy going in here over the past several weeks because the market's been just choppy and it's been mostly sideways or to down, more down than sideways. But the market needed a pullback. It needed some profit taking. I think we've kind of worked our way through that. And quite honestly, we're seeing the market rebound back through some key moving averages, confirming what I suspected, which would be that we would go through a period of chop and consolidation, maybe even a little bit of selling. And when you start going below the moving averages and then right back up above the moving averages, then back down again, then back above, that starts to give you the feel of a trendless market, one in which, we're just, like I said, doing a lot of chop. I think Wall Street repositioning, we're kind of watching the inner market, inner sector, inner industry group relationships, trying to get an idea, a good sense of where the market is repositioning. I don't think this is anything like the beginning of 2022. For those of you who are maybe thinking, hey, here we go again to the downside. I know I've seen some news stories and some media headlines that suggest that. I don't think that at all. I said back a month ago, I thought we needed to go through a period of selling, consolidation, kind of unwind, a lot of overbought conditions, negative divergences, and so forth. I think it's been pretty successful. Actually, we fell back more than I anticipated. I thought maybe we'd go to the 50-day moving average because of those negative divergences, but I wasn't looking for a whole lot more. We went a little bit below that. Now we're coming back up through. I think that's very notable and something we need to continue to monitor and keep our eye on. But again, thanks for all your patience and understanding. It's been a pretty tough time for the last couple of weeks, but we're back. Hopefully things will start to get back to a normal schedule, but I'll certainly keep everyone posted. All right, let's move on and talk a little bit about what happened yesterday. As I mentioned, pretty good action. Dow Jones Industrial Average up 292 points, S&P up 64, NASDAQ up 324 points, mid caps up 36, small caps up about 2.5. On a percentage basis, NASDAQ showed leadership yesterday, gaining more than 2.1%. Really across the board, S&P, mid caps, small caps, all up around 1.4, 1.45%. Excuse me, the Dow was the laggard, rising a little bit more than 0.8%. You can see the transports also right around that 0.8% mark. Did come up, challenge the 50-day moving average, unable to break through it, but sitting almost squarely on it. We got the 50-day at 15,853.79, We closed at 15,853.14. So literally less than 1 point from breaking above the 50. The Russell 2000 closed back above its 20-day moving average. Still got a little bit to go to get through its 50. Mid caps have clearly gotten through the 20, up approaching the 50-day moving average. NASDAQ 100, which I tend to look at as kind of the leadership index, the index that we really want to lead because it houses so many aggressive growth names. The NDX up to 15,376. The 50-day was 15,217. So this was not just a nip of the 50-day moving average. This was a pretty significant thrust back through that 50-day moving average. The S&P 500, the 50 days at 44.61. We closed at 44.97 and change. So very significant move there. Remember, our highs recently were up at about 4,600. The lows had dropped down closer to about 43.40. The fact that we're sitting at almost 4,500 right now, we're closer to breaking out than we are to breaking down. Pretty significant day yesterday in terms of our gains and what we were able to do in terms of the moving averages. The Dow Jones also climbing back above both of its key moving averages, the 20-day and the 50-day. Really good action overall across all of our major indices. Looking at sectors, we saw exactly what we want to see as you go back through the 50-day moving average. Leadership from discretionary, communication services, technology, all of those gaining between 2 and 2.5%. Automobiles, big winner because of Tesla. Automobiles up 6.8%. Tesla was up 7.7%. And then recreational services, kind of everybody's fallen asleep to those cruise lines and so forth. But recreational services made a pretty good jump yesterday, rising. Actually, I think I may have added the wrong one here. I mean, recreational services had a good day, but I think it was recreational products that actually had the second best. So let's take a look at recreational products as well. So we got recreational services. When I say I haven't had a whole lot of time to prepare, I'm not kidding. Recreational services are trying to move back up. And by the way, that 92.5 level, pretty good support because the first key move back down in the recreational services area after the huge move up in June was back to that 92.5, 92 level, just below 92.5. And if you notice from the double top, we've come back down right to that 92.5 level, trying to turn back up yesterday. Still got some work on recreational services to get through. The one I meant to put on here this morning and just made a mistake, but recreational products. So recreational products have been getting hit pretty hard. Big move yesterday, though, up almost 3%. That, along with automobiles, is what led the consumer discretionary group to the upside. But recreational products still has some work to do because of the big drop. The 20-day coming below the 50-day right now. We have the PPO, which is down below the zero line. So that's telling us momentum is still a little bit negative, although we are starting to turn back up. That's at least an initial positive. Got to get back through that 20-day moving average. That's going to be the first step for this group and for many groups that are starting to make a turn. Like I said, some have already made the turn through the 20, even the 50. Others are just thinking about it. Well, if we're going to go back into a secular bull market advance and break back out, we really want to see wide participation. So we want to see areas like recreational products not just turn up, but actually start to clear some significant hurdles on the way up. So the 20-day would certainly be the first one, and then the 50-day. And then you could start maybe looking at some type of a continuation pattern, whether it be a cup maybe that forms back up to 580, maybe some sort of maybe move back up and print maybe an ascending triangle where you get equal highs, rising lows. Those types of things are the types of patterns that I'm going to be looking for as we move forward. Let's keep moving on. 10-year Treasury yield. So I did not take a look yet to see what economic reports we have out today, but I'm going to take a look right now. I believe the ADP report came out this morning. Yes, ADP employment report out this morning. The the August report is what we were waiting for. So July had come in at 324,000. That got revised higher to 371,000. August is, well, the expectation was 200,000. It came in positive, but only 177,000. So I guess there's a lot of different ways to look at this. Those of you that are in the bear camp, which I'm not, but I try to take a look at this from all angles. Those in the bear camp might look at this and say, well, see, here's where the slowdown's starting. So jobs in July, 371,000 revised, now down to 177,000. But the bulls might look at the exact same data and say soft landing. This is what the Fed's been talking about, that, hey, we think there's still a decent chance for a soft landing. Low job growth will help to keep the pressure off the Fed to raise rates. It'll also keep pressure off of wages, hoping to keep the wage inflation down. So again, it depends. You can take data, and flip it any which way you want and write an article and put your headline on top of it. You can spin it. And one of the reasons why I don't like the news is because it's not really news. It's really opinions. Everyone's just spinning the news in whatever favor is, most favorable for them. And so a lot of times, unfortunately, with media, bad news sells. If you start painting a rosy picture, you're not going to get as many clicks. If you start saying, hey, this looks like a slowdown, recession coming, that's going to get a lot more clicks. But bottom line is, futures turned higher when this news came out at 8:30, because earlier this morning, futures were down a bit. Last time I looked, they were up a bit. Let me take a look. We'll look at this together because I didn't talk to you about the futures. But there you can see the diamonds, DIA, which tracks the Dow Jones, currently up about 0.25%. The spider up about 0.1%. So that not doing quite as well. QQQ relatively flat. But again, this is all better than what we looked at a little while ago. And then the IWM down about 0.25%. So a mixed picture, but some up, some down, overall pretty flat, which again is better than where we were prior to the news coming out. So let's go back. I wanted to look at that TNX one more time and look at the other economic headlines, any other news that's out. GDP came out 8:30 this morning, and the actual number 2.1%. The estimate was 2.4, and the prior was 2.4. So this was the second estimate of second quarter GDP. So first quarter came in at 2.4, but that's actually been lowered now to 2.1, the second estimate. The PCE, the annual rate of personal consumption expenditures, the prior report 1.6. This second estimate was supposed to be 1.7. We came in at 1.7. So no big surprises to the upside in terms of inflation, but there was a little bit of a surprise to the downside in terms of the GDP. So I read that again to be somewhat bullish. Nothing there, in my opinion, to trigger the Fed to say, hey, we need to raise rates. Of course, I'm to the point where I'm not quite sure what the Fed's going to do from month to month. It looked like they were backing off of interest rate hiking, but then from Jackson Hole said, hey, we may have to continue hiking. And I know he's, Powell has said a lot of this in the past, but the overall theme or strategy of the Fed seems to have changed a few times over the last year and a half, maybe 2 years. And I think that's part of what the market is having, the stock market's having a little problem getting a hold of, is exactly what the Fed's going to do, because it's not exactly what they have said in the past. So anyway, enough of that. Let's see, what else did we have for this morning before I get into his charts? Let's see, wholesale inventories came out. I don't really, well, I guess we can take a look at that. Let's see, wholesale inventories were expected to drop by 0.7%. They dropped by 0.1%. Retail inventories. The actual last month jumped 0.7%. And I'll tell you, one of the fears that I've had is that the Fed, if they slow things down too much, inventories will build, especially at the retail level. And that would be a problem, because then you would start to get into a situation where retailers have to start lowering prices and lowering prices and lowering prices in order to induce buyers. And that can result in deflation. And throughout this entire period of inflation, I've not been worried about inflation. The market's telling me not to worry about inflation. So that tells me the alternative, deflation, is probably the bigger threat. And so I watch the inventory, especially at the retail level, just to see what's going on with those inventories. Anyway, the prior of 0.7% was revised down to only 5%. And then the current for this past month, which actually was July, is 0.3%. So at least the inventories are moving in the right direction. All in all, I think the market data and the economic data that we're getting this morning seems to be pretty decent. We will have pending home sales out later this morning. That'll be at 10 a.m. Eastern. And the expectation there is for a drop of 0.4%. Last month, and the 0.4%, that's for July. So last month, which would mean June, we saw a rise of 0.3%. So essentially, we're giving that back. At least that's the expectation. So those are the economic reports that you need to be aware of for today. And so let's keep moving on. Let's take a look at what's been going on in the market, because honestly, with a lot of the traveling I've been doing and a lot of the personal matters we've been dealing with, I haven't really had a chance to look at the market throughout the day like I normally do. So I'm kind of going back and looking at this. I was exhausted when I got home last night, didn't even look at any of this. So I'm kind of looking at this for the first time, along with you all, who probably looked at it a lot more than I have. Anyway, S&P 500, look at that move. Nice move back up above the high that was established with that NVIDIA report. Remember that last week? That came out on, well, they reported, I think, Wednesday. So Thursday morning was the reaction where we saw that gap up, and then the big selling. I want to go back to last August, because I want to show you the Jackson Hole, what happened with Jackson Hole. Here is where the market topped just past the middle of the month. And then we came down, had a little rally. And then right here, this big red candle was the speech, the Jackson Hole speech by Fed Chief Powell. And you can see we had bearish engulfing candle from the moment he began speaking. You can see we had a sell-off for 6-7 days, huge sell-off that day. It extended all the next week. We went from, what is that, right around 4,200 down to probably 3,900 in a little over a week, 7% on the S&P 500. We had one little pop at the beginning of September and then new lows. So obviously, I was certainly looking at this as a possibility that, hey, if the Fed says something crazy again, last year, remember, it was the more pain ahead, talking about the stock market, which I've said, never a good idea for Fed chiefs to start prognosticating or becoming a prognosticator of the stock market. It's not their expertise. That's not what they do. Anyway, after that, you can see the big sell-off, a little bit of a bounce, and then the sell-off continued until we finally set that final low in October. So the big question going in was the Fed going to say something, I'll just say it, dumb again? And the answer was no. Actually, I thought the speech went about as expected, but you can see with that with that NVIDIA report, we had a very similar look. Breaking down, we were up trying to break through the moving averages, failed. I mean, after you go down and you're trading below the 20 and the 20s trading below the 50, and you gap up like this and fail, normally I would say, if we're really looking at a bear market, 9 times out of 10, you're going to see tremendous follow through from that candle, because this move back up is the first chance for everybody else to start getting out of the market. First leg down, usually, the final move up and the first leg down is usually Wall Street, because everybody else is bullish. Everybody else takes a while to begin to think that things are going to get worse. So this first move down is usually Wall Street, and then you get a bounce, And then you get another move down. It's usually the second or third move down that retail traders start to begin to get more and more bearish as they lose a lot of money. That helps to make you bearish, by the way, if you're losing a lot of money. And so once they get down a lot, then they begin to chase. And that's what happened last year, going all the way back. And I'll pull this up, go back a little bit further. But it was probably around May and June. This is when I started talking about the equity only put call ratio finally beginning to reset. And that is a look at retail traders. I mean, when you look at equity only put call ratio and you look at options and the options that are traded on equity only, not the index options, not any other contracts that, are maybe, more diversified, but individual stocks. This is what retail traders tend to do. May and June, they started sending signals that they were all in on the short side. That's not a good thing at all. And that was one of the reasons why in mid-June I called a bottom. And again, thanks to the Fed, we went down, we had another low. I don't think we would have had that low. We'll never know. But I don't think we would have ever had that low if it wasn't for the Fed. That's what started all this to the downside. So again, the question was when we got into last week, were we going to see something similar where we moved down here over here, August, moved down, had a little run back to the upside and then new lows. Notice we never got back through where the selling started. And that's why I think this is a little bit different, more significant. Number one, all of my signals that were bearish back last year throughout the first half of 2022, none of them are present right now. None of them. I don't have anything looking at all like what we saw going into 2022. So I've said all along, it's a correction. It's a pullback. Call it what you want. We're going to go back to new highs. I still believe fourth quarter, we'll see all-time highs. None of that's changed. And now yesterday, I think was the first confirming sign of that. Not to say that we can't go lower. Market, anything can happen in the market. But when you start to trend below these moving averages, bear markets don't just rally back without some rather significant reasons. For instance, I think back in March of 2022, we had a big recovery. Actually, here it was. We had a big recovery, but I could tell you what it was. We had the most in the money put premium that I've ever seen in mid-March in terms of options expiration. And guess what? 4 days later, we went all the way up and hit max pain. So sometimes there are short-term, I call it inefficiency in the market, but there are reasons for the market to bounce back. There really wasn't any massive reason for this market to do what it did yesterday. And so as a result, this to me is just confirming what I believed we started back in mid-July, which was a period of consolidation. Up, down, up, down. When you're trending lower, you tend to fail at moving averages and move to new lows. When you're trending higher, you tend to hold moving averages and move to new highs. That's the way the market normally works. Here we moved down, we failed at the moving average, started to roll over. It looked like, hey, here we go to the downside. Instead, we break back up through the moving averages. So I would just be really careful on the short side. I don't think that all the difficult market is necessarily over. I think throughout probably the next 3 or 4 weeks, this is typically a rough time of the market. I wouldn't be surprised to see some moves above and below the moving average. What this does for me, though, is it now establishes that recent low as a very important low. I mean, we got down below 43.50. 43.05 is still the price low, but this is starting to tell me we're not going to 43.05. So I like this movement back to the upside on the S&P, and I think we'll likely see more sideways consolidation, but eventually a move back up to test 4,600. And if we break back out above 4,600, especially with the fourth quarter around the corner, I'm going to be looking at 5,000 in the fourth quarter. Let's take a look at the NASDAQ 100. Another one broke back up above the moving averages. Looks very similar, so I'm not going to spend a whole lot of time there. The IWM small caps taking a little bit longer to get going. but we did move back through the 20-day yesterday. I showed you in pre-market, it's down a little bit. Let's see if it holds that 20-day moving average today. That's one of the things I'll be watching. Moving on to the transports, back up to the moving averages, both the 20 and the 50. Any additional strength today in the transports would be welcome. That would be very welcome technical news for the bulls. All right, chart of the day. If you're a fan of the chart of the day, if you like taking a look at individual charts, I try to use those charts to teach some of the areas of technical analysis or just some of the areas that we feel are so important to us. Relative strength. At Earnings Beats, you probably can understand we focus a lot on earnings and in particular earnings beats. So we feature a lot of companies that post solid earnings and gap higher. Sometimes companies that don't post very good news and gap lower, creating some pretty key resistance areas we focus on. So a lot of that, candlesticks, which I'm a big fan of, your typical moving averages, of course, price volume. It's always big in my technical toolkit. So all of those things are things that we tend to look at. And if you're interested, it's free, completely free. We do this to give back to the community who supports us. But Earnings Beats Digest is a completely free newsletter. And it's not your typical newsletter. It's 2 paragraphs in a chart. Very simple to read 3 times a week, Mondays, Wednesdays, Fridays. Name and email address. That's all it takes. No credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. I'm doing this because I'm thinking I'm helping the community. If you don't see that there's any help, it's not really helping you. You're not hurting my feelings. Feel free, unsubscribe. But the other reason to subscribe, when we do free events, we reach out to our free newsletter. All the Earnings Beats Digest community, obviously, in addition to all of our paying members, we do reach out for our free events to this newsletter subscription list. So make sure you type in your name, email address, get started. Here is your chart of the day for Wednesday, August 30th. Array Technologies. And so what I pointed out yesterday, there's a lot of us. I like breakouts. I like to play breakouts. I'm sure many of you do as well. Here's a stock that has really not been kind to those of us who like to play breakouts. Here you can see Array Technologies all the way back to November of last year when we set this high. Notice a month later, we broke out above the high. And that's typically a breakout when you're clearing previous highs. So here we made the breakout, and subsequently over the next 3 weeks, we lost probably 30% on Array Technologies after making the breakout. So if you didn't keep a tight stop, it was a painful next 3 weeks, losing almost 1/3 of whatever capital you put into this trade. And then look again in January, right after this low, comes right back and look, breaks out again. And what happens? 2 days later, it pulls back probably more than 10%, and then comes back another time. So here's 1, 2, 3 breakout attempts. And it looks like it made it on the close. Nice confirmed breakout, right? Look what happens next 2 months. Right back down, you lose another 30%. Then fast forward all the way to May, and guess what? We cleared the January high. And almost the very next day, we fail. And we start a 2.5 to 3 month decline, which again is getting close to 30%, certainly more than 25%. And guess what happened yesterday? Array makes another breakout. 2470, closing above any of these prior closes. How good do you think I feel about playing a breakout on this stock? Not very. Although I will say this, volume was very strong with this earnings. If you go back, this move up, the volume was heavier than any other day over the last year. And it was followed up with some pretty good volume and higher prices the next couple of days. Pulled back to the moving averages, nice bullish engulfing candle. And now we're making the move. And look at the volume yesterday. There's pretty good volume on this breakout. I still can't ignore the history of what's happened on these breakouts. So I'm not going to trade it, but I do think it looks a little bit better than the others. Notice when we made this breakout, negative divergence, we made this breakout. Yeah, we were showing a little bit more strength in terms of momentum. Here, we topped again right at about that 5 level. This one, we actually moved back up higher than the prior high. And we've done it with a lot more volume. I think the volume trends look better this time than they have in the past. But still, the ghosts of prior breakouts haunts this stock. It'll be an interesting one to watch anyway, because every one of these prior ones, one day, that's all it lasted, and right back down. So if recent history holds, we're probably going to see a big sell-off on ARRY today and maybe over the next few days. But anyway, I just thought this was an interesting chart just because, technically it's done some things that normally are very positive, but technical analysis doesn't always work. And a lot of folks who don't, who aren't fans of technical analysis aren't fans because they always point to the failures. They don't point to the fact that technical analysis can be used to help manage risk. They only point to when things don't work. And they say, see, technical analysis doesn't work. Well, that's, I guess, in the eyes of the beholder, right? I'm a big fan of technical analysis, and I use it to manage my risk. All right, a couple of other things that we can take a look at here. First of all, the S&P 500 with this long move up and then the pullback. We've seen pullbacks. These are all of the growth ratios that I like to look at and that were telling us that we were going to get hammered back in 2022. They're not really saying that here. Notice the S&P 500 right here to open August, even with yesterday's advance, we're still well below the August high, right? Here, the QQQ versus the spider, slightly below. Here, the XLY, XLP, consumer discretionary throughout August so far, discretionary is beating staples. It's actually outperformed. That would not happen in a secular bear market. That's not what happened in the cyclical bear market that we saw in 2022. This group was getting absolutely hammered throughout. Even the bounces never came back anywhere near the prior highs. This is actually breaking to new August highs while the S&P is still down from its August high. And I look at the growth ratios. Here's large cap growth versus value, these next two. I see higher in August. Here I see equal to maybe slightly higher in August. Mid cap growth versus value, higher in August from where we were at the beginning of the month. Small cap, higher than where we were at the beginning of the month. Does it look like we're bailing on growth stocks throughout this downtrend? Because in a cyclical bear market, that's typically what happens. I'm not going to say it always happens, but again, what we're trying to do is put the pieces of a puzzle together. You can always, if you're bearish, you'll always find something that's bearish. If you're bullish, you'll always find something that's bullish. And so you certainly can find things to support what you believe. Confirmation bias. And I had one member write into me saying he thought I was guilty of confirmation bias. I think I'm just following my signals. I mean, look at the 5-day equity only put call ratio, still sitting up above 0.80. Market's going up. And the options world remains bearish. That's awesome for the bulls. It's awesome. Because rarely do you see a 5-day moving average where it sits right now and you see the market go down much further. I believe we're starting the big rally off of what we talked about when we first got up to that 0.85 level. So I'm just not seeing it. And if you want to call it confirmation bias, feel free, but I'm not seeing it. Semiconductors. This is a group that I'm watching because obviously a breakout here would be really important. We're trading way off the earlier lows. We're above the 20. We're above the 50. I think the group looks good, although we haven't quite gotten through where we were when we opened the day after NVIDIA reported its earnings. So watch that level, watch the tops around 10.5. If they go, I think the market's going to go. Software also trying to get through the high that was established after the NVIDIA report. trading right up to the 50-day moving average, just above it, 54.24 versus 54.21. And then internet, another big area that's been trending higher, pulled back, tested this gap support, now starting to turn back to the upside. And we did take out the high established after the NVIDIA report with the strength yesterday. So all of these groups looking pretty good to me. Still sideways consolidating. We haven't broken out, but you have to respect the market for what it's doing and for what it was expected to do. Remember, when we look at the S&P 500 and we look at the daily chart, when we set that final high, we had negative divergences. Look at the NDX. It was very clear. High, excuse me, high and a lower high. So we've got a very significant negative divergence on what I think is probably the most influential index. And so as long as this was going down, it was going to be difficult for the market. Well, now we're going up. We're trending up above both moving averages. Notice that PPO getting ready to head into positive territory. I like what's going on here, and we'll just have to see, if it continues. So let's take a quick look overall and see where we are. We got the Dow up. We got the S&P up a little bit less. We got the NASDAQ right about break even. NASDAQ 100 down about 1.1%. Small caps, mid caps down a little bit, maybe lagging just a bit here in the early action. I don't know if you noticed yesterday, they lagged in the first 10 minutes or so, and they're 5 minutes and absolutely exploded back to the upside. If we take a look at the IWM, this will be the last chart and we'll wrap up here. But on a 5-day, look at this. This thing was down quite a bit initially, and we just saw buying all day long. Here we are down again in the morning. We'll see what happens if we got similar fate for the small caps, but at least over the course of the last few days, you can see we do have an uptrend established, not only on the small caps, but across just about every asset class in the market. All right, so that's it for me. I appreciate you tuning in. Again, thank you all so much for your patience and understanding. It's been a rough couple of weeks for me personally. Things hopefully are on the improve in that area, though. I do want to thank all of you for checking us out on our YouTube stream. Please like the video below if you do like what we do here at Earnings Beats. You like these shows. Also, be sure to subscribe to our channel. We do free events from time to time. If you subscribe and then you turn your notifications on, if we do anything, if we start any kind of an event, you'll be notified. So it's really important to make sure you not only like the video, that actually helps us, but also subscribe to our channel. And we certainly would appreciate your support there. Have a great day, everybody. I'll be back tomorrow for your next Trading Places Live. Again, today's trading room has been canceled just because I've had no time to prepare for it. Hopefully you understand. We will be rescheduling the all-day trading room that we had planned initially for today. And my guess is it'll probably be after earnings season. What we'll probably do is do 2 of them next quarter instead of 1. We've been doing 1 each quarter. I think we'll probably do 2. I just think it'll make a lot more sense. I think we'll have a lot more opportunity if we wait and do it during a period where we have earnings starting to pick back up again. So watch for that announcement. We'll try to get that out to you as quickly as possible. But my guess is it will probably be after earnings season starts, probably sometime in the 3rd or 4th week of October. Anyhow, that's it. Have a great day, everybody. Happy trading.